Hello, Archers. I covered taxes in my last video. Just a basic overview. If you could check it out in the there's a link in the description below. Today we're going to talk about how life insurance works. So we're going to reference back to our financial house, which we watched in our first video. It was one of our foundation elements of our financial house, keeping it secure, keeping it stable, preventing it from collapse. But what's not understood sometimes is what is life insurance and what are the types of life insurance out there. So we'll start with a very basic life insurance, something called group insurance. Group insurance is a type of insurance, life insurance given out by your employer as employee benefit. They lump everybody together into one single insurance plan. These type of insurance plans are an employee benefit. They are very inexpensive. But believe it or not, less than 1% of these policies ever pay out. The reason being is that a lot of people will be at a company for several years, and then they will leave and they'll lose their insurance. An example of group life insurance, if you're in the military, is service group life insurance. I spent 22 years in the Air Force. I paid $18 a month for life insurance, for $400,000 life insurance for 22 years. And when I left the Air Force, I lost my SGLI, my service group life insurance, and I had to go out onto the market and shop for life insurance for myself. And at that time, I was not a financial advisor. I was getting ready to go to work as a bank manager, and I had no idea how life insurance worked. So, to give you a lesson that I wish I would have learned a lot younger in life, there are two types of personal life insurance. One is called term insurance, and one is called permanent life insurance. Okay, term insurance is essentially renting a policy. Okay, permanent life insurance is owning a policy. Term insurance is taken out for a sum of like 10, 20, sometimes 30 years. Okay, it's very inexpensive. But believe it or not, less than 2% of these policies will ever pay out. The reason being is that when you're 25 years old, as an example, and you get term insurance, when you go to renew it in 20 years when you're 45 years old, it's going to be very expensive because it steps up in price. When you get your medical evaluation when you're 25 years old, you're in great health. That's one of the best times to get life insurance is when you're 25. So, but when you go to renew it, you're going to have to do a new medical exam. And after 20 years, you're not as healthy as you were when you were 25. But the nice thing about term insurance is usually within the first 10 years of owning a policy, it is convertible to permanent life insurance. So that's a benefit of having term insurance, especially at a young age. Now, permanent life insurance is the complete opposite of term insurance. You own this to age 100. Okay. If you're making your premiums, it has a guaranteed payout. There are two parts of permanent life insurance. There's the actual insurance part, and then there's what's called the cash value. And this makes up what they call in the insurance world the death benefit. Now, the reason they call it the death benefit is because if you, God forbid, if you were to pass away, your insurance, which is covering your death, and the money that's inside the cash value gets paid out in a lump sum. The biggest benefit of permanent life insurance is that the cash value is a tax-free growth asset. These are not investments, they're insurance policies, but the way that they're structured inside the IRS is that you can use these to grow money tax-free. Now, there's 3 different types of permanent life insurance, and there's 3 different types of tax-free growth that you can achieve in them. There's whole life, which is a dividend-based growth asset. Okay, the profits of the life insurance company will pay you every year to have a life insurance, the whole life policy, and they take part of their profits and pay you in dividends. Sometimes between 3 and 6%. Very safe asset. There is what they call universal life, which is paying your cash value in the Federal Reserve rate. Okay, so I'm not sure what the Federal Reserve rate is right now. Somewhere between 7 or 8%. They will pay you that annually based on your cash value. This one goes up and down based on the Fed rate. Okay. The third type is what they call a VUL, Variable Universal Life, or an IUL, which is an Index Universal Life. And these are based on market returns. Stock market. So these are very risky assets, but they have high reward if they're structured correctly. So from top to bottom, the lowest risk is going to be whole life, which is going to pay dividends because the companies are very profitable. They've been paying profits since like 1860 on some of these companies. Universal life, which is based on the Fed rate. Okay. And then universal a variable universal and index universal are based on market returns. I'm going to do a whole video on how all 3 of these policies work. All these types of different permanent life insurance policies work. I don't want to get too far into the weeds with it. But this is the very basics of how life insurance works. So I got to ask you a question. Are you properly covered?